Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you that it was just posted on YouTube. Now, if you're not on my email list, click the link associated with this video to get on it. And if you're just randomly watching on YouTube, click the subscribe button and then the bell, and then YouTube will notify you instantly when the next video is posted up. Because we're in a really interesting moment now when it comes to gold, silver, and the mining stocks. They completely soared after the stock market bottomed out in March, went up much more than the stock market did. Silver went up more than 100%. But since the end of July, they have been pausing, correcting, consolidating off of their 50-day moving averages. However, today something very interesting has happened so far. Gold fell about $30, but the mining stocks started to come back up while gold was still trending down around lunchtime. The mining stocks are actually starting to perform better than gold. And you can see from this chart here, the GDX gold stock ETF is simply consolidating, simply going sideways. And the most important indicator I use to understand or identify the trend here is the GDX divided by gold ratio. It's a relative strength ratio. When it goes up, it means that GDX is outperforming gold. When it goes down, it means the mining stocks are performing worse than gold. This is important because the action in them tends to lead to action in gold. So when this ratio is going up or simply going sideways as gold is weak, it's a bullish sign. It means that this is not a bear market, it's not the start of an extended decline, but a simple pause in an overall trend. This is what the short-term chart is showing us, but when it comes to the long-term trend, this indicator, if you go back on long-term charts, is showing us something even more fascinating. And this is something I spoke about with Jordan Roy-Byrne, who runs the website, thedailygold.com. He just did an article posted on his website analyzing this ratio and the long-term implications of what it says. So I talked to him on the phone and recorded that conversation. I'm going to post it right up, and let's go to it and listen, and I'll show you his charts.
Hi, how you doing today, Jordan?
Hey, Mike, I'm great. How are you?
Oh, I'm doing good. Very interesting times that we're in when it comes to gold, silver, mining stocks, and even small cap miners. But the people are nervous about the recent consolidation, correction, whatever you want to call it, that's been going on, still going on. However, today, as we're speaking, gold stocks are up, even though the price of gold is down. Well, actually, I'm wrong. The gold stocks are down like less than 1%, whereas the price of gold is down almost twice as much. But on the chart, the ratio looks pretty good on a short-term basis. But you got a really interesting article about the long-term charts on these ratios that you posted up. I'm going to link to it so people can look at it themselves.
Yeah, so in the article I looked at, basically we're looking at gold stocks versus gold stocks versus the S&P, and gold versus the S&P. And what we see is all of these charts are basically in this big, broad, bottoming, basing type formation. And this kind of started since 2013. And everyone will recall this formation, this big, long, bottoming, basing pattern. This is exactly what GDX and GDXJ were in and they broke out of that pattern in the last couple of months. They broke past 7-year resistance. So that was hugely significant. And I mean, even for gold, gold's breakout, I think, was in 2019. I don't have the charts in front of me, but gold was the first to break out of the big bottoming basing pattern. Then the gold stocks did in the last couple months, the last month or two, silver as well. Now, these ratios have not broken out yet, but I think they're setting up for a breakout sometime in the next, it could be 5 months, 6 months, 9 months, somewhere in there, Mike. And the real significance of that is, so if you see the gold stocks breaking out against gold, that would mean that moving forward, the gold stocks would strongly outperform gold. Now, at the same time, if the gold stocks, the ratio, if GDX breaks out against the S&P, gold stocks would strongly outperform the stock market. And then finally, gold could break out against the S&P and strongly outperform the stock market. And so that the gold to the S&P ratio, Mike, the resistance is close to 1. Or excuse me, the resistance is close to 0.7. So if and when that ratio breaks out, Mike, the measured upside target is close to 1. So that could mean at some point in the next few years, gold could be at the same level as the S&P 500, which, I mean, what is it at, 3,500 now? So look, I mean, even if that corrects and goes to 2,800 or 3,000 or whatever, I mean, that's still a significant move higher for gold. And, I want to circle back to gold stocks outperforming gold. But, Mike, that really has not happened on a consistent basis really since 2005 or 2006. I mean, I know it occurred in 2000, late 2008, 2009, when we had the sharp rebound during the GFC. But then, I mean, early 2010, the outperformance of the gold stocks against gold, it really trailed off. And then, yeah, you had it in 2016 for about 6 months. But look, other than those 2 points, Mike, we have not seen gold stocks strongly outperform gold for a sustained period of time, really for 15 or 14 years. So, I mean, these ratios are setting up for significant breakouts over the next year or so. And if that comes to pass, what that entails is it's really significant. What it would mean is you have capital moving away from the stock market into gold, and then even more so into the gold stocks. So, I mean, we've seen a rebound. I mean, we've seen precious metals have fantastic moves, but the stock market has also rebound to a good degree. I mean, it's at all-time highs again. So, I think that the significance over the next couple of years, if these ratios do break out, the significance is you'd see precious metals perform really, really well. That would continue, but it would be to the detriment of the stock market. You would see some capital move away from the stock market and into precious metals.
Well, is it possible, just last week, it's amazing how so many things happen in the news that a lot of events just kind of fall by the wayside. We had the Republican convention and more news associated with rioting and this and that. But on Wednesday last week, Jerome Powell issued a declaration that he wants inflation above 2% for an undeterminate future. Which is a rapid, dramatic change from previous Fed mandate. Is it possible that we can get higher inflation that helps the stock market, so the stock market doesn't have to crash for gold to go up necessarily, but maybe just gold goes up more or something, kind of like the 1970s or last half of the 1970s?
Mike, that's an excellent question. And when I looked at, I looked at the CPI, the inflation statistics, and I know that the inflation statistics are really not accurate, but what you need to pay attention to with the CPI is really the trend and the direction. Doesn't really matter. I mean, it doesn't make a huge difference what the number is. It's really the trend and direction of the CPI. And if you go back to the 1960s, I don't have the chart in front of me, but basically the CPI made 2 breakouts. It made like a little breakout in 64 or 65, which was significant. And then I think it made a really significant breakout in 68 or 69. And actually, Mike, when it made that significant breakout, that was basically when commodities really started outperforming the stock market, and when the stock market, the bull market, was really over in real terms. And so to fast forward that today, at some point, I think if you're looking at the CPI, if you're looking at a historical chart, go back to like 1990, and you can draw a down trend line from 1990 until today. Now, I don't know where the breakout point is. It could be 3%. It could be 3.5% CPI. I'm not looking at it. But eventually, Mike, when that breaks the downtrend line and gets above 3% or 3.5% or wherever it is, that will be the point when the stock market can no longer be helped by inflation. That'll be the point when the bull market in the stock market is really over, and then the stock market will have problems with inflation. It'll start impacting these corporations. But here and now, until the CPI gets above that resistance around 3 or 3.5%, the stock market will be okay. But eventually, when that happens and the CPI breaks the downtrend line, that's when you'll see capital move into, like I said with the ratios, it'll move more into precious metals, gold stocks, and commodities as a whole.
Well, one thing interesting to me too is I've been looking a lot at foreign currencies, instead of just looking at the U.S. dollar index. And your ratio charts here show that the resistance that they're now trading under goes all the way back to 2015 and 2016. So that's why it's such a significant thing if it would break it, as you were stating earlier. One interesting thing about this is that a lot of these currencies, such as the euro and the Swiss franc, are also sitting on resistance levels that go back to 2015. So it's almost as if all these things might influence each other or happen at once.
Yeah, I mean, it's very possible. It's all going to be linked up. These specific breakouts, they may not all happen at the same time. I'd have to, as far as which one will be first, I'd have to look at all these charts. I don't have them in front of me at the moment. But if this plays out, you'd see a move that's related across the spectrum. In other words, commodities outperform the stock market. I mean, that'll happen secondarily. I mean, first and foremost, precious metals, gold stocks outperform the stock market. Gold outperforms. Silver outperforms the stock market. Then you see the dollar's breaking down more. So the other currencies are breaking out against the dollar. And, at some point, if the CPI gets to 3 or 3.5%, that's when the stock market starts underperforming everything. So, yeah, there's many markets that can be linked up. And, precious metals are usually the first to move in that regard.
Well, it's going to be fascinating to watch how this unfolds over the coming weeks and months. And I'll be following what you do at thedailygold.com to see your updates. And hopefully we'll talk more frequently before the end of the year. But as we wrap up, could you tell people what you provide at your website, thedailygold.com?
Thedailygold.com provides all of my free information. I post interviews like this, articles, editorials. I do audio commentaries. I do video analysis. So you can find that at thedailygold.com. That's all my free information. And I also have a premium service. You can check that out at thedailygold.com/premium.
Well, great. And thanks for taking the time to talk to me and my listeners, and we'll talk again soon.